We want to bring in Tamar Essner, Vectis Energy Partners Principal. Tamar, it's great to see you here. So let's unpack what we're seeing play out within the space, because the deal that we got from Chevron earlier this week obviously followed what we heard from Exxon, and it's this move that's doubling down on fossil fuels amid this transition, more broadly speaking, to clean energy. Why do you think these oil giants are deciding to go this route, and could it potentially backfire?
Thanks for having me. Just to clarify from your opening remarks, I actually do think that Exxon and Chevron will continue to make purchases, and there will be more mega purchases, just not in the near term. I think that those two companies are the most natural acquirers, and they've just made these two recent big acquisitions, as you noted, and it will take some time for them to digest. In the meantime, I think that there'll be more mergers of equals as the sector has to consolidate to achieve size and scale. To compete in a world where there is questions about the long-term terminal value of oil. And after there is more consolidation, I think ultimately Exxon and Chevron will then continue to acquire those bigger companies. So I just wanted to clarify that. I think that these deals make sense, though, whether you agree as being a bull on oil prices in the long term or as a bear. I think that there's a lot of rationale for these types of consolidations.
Tamar, what is that? And apologies for mischaracterizing what your expectations are. But when we talk about the rationale here, why this makes sense, why do you still think it makes sense at this point?
Well, a couple of reasons. First of all, a lot of the best acreage in the U.S. Has already been acquired and been drilled. So I think that these companies are going to need to consolidate to deal with having more contiguous acreage that is in the best plays. And then at the same time, by reducing overhead, basically eliminating CEOs, eliminating headquarters, you're able to take down your production costs. And therefore, you're able to compete in an environment where oil prices are more volatile. And I think the last point is that it's really notable that these two acquisitions, both of Pioneer and of Hess, are buying assets that are mainly in the U.S. or in the Western Hemisphere more generally. And I think that what we've seen from recent global events is that energy companies have had to pull out of operations in Russia. There's obviously now big concern about operations in the Middle East. So I think that companies want to the extent that they're going to double down on oil assets, do so in environments that are stable and sort of closer to home and predictable operating environments.
Tamar, what do these acquisitions signal for any prospect of a clean energy transition to combat the adverse effects of fossil fuels?
I think that these deals are actually supportive of that, because even in a transition to greener energies, we are still going to need oil and natural gas for some time. So this basically ensures that those assets will be developed in a way that's cleaner and with a lower production cost. At the same time, by combining companies, these companies are able to rapidly increase their shareholder buybacks and their dividends. So they're basically returning enough cash to shareholders that they are basically a free value, sort of like a freebie on the price on the terminal value of oil. Basically, they're saying we'll pay you back for all your investments. So if oil isn't here in the future, don't worry, you're already going to get more than paid back. At the same time, with that money that you've been paid back, you can invest that. The free market can invest that in green technologies, basically saying the free market can do that better than we can as a traditional fossil fuel company.
Tamar, when it comes to your outlook here for crude, the prices that we will likely see, we haven't really seen this massive move higher that many were bracing us for, as we saw following Hamas's attack on Israel. When we talk about the implications of potentially an escalating conflict, which you started to see here play out within the Middle East, what does that mean more specifically for crude in the short term?
Well, I think that the market's not good at understanding geopolitical risk, and it will fade that. The reason the market has been so complacent about the recent events in Israel with a war with Hamas is because there is so much spare capacity. Remember that Saudi has 1 million barrels a day just in unilateral cuts, in addition to all the OPEC production cuts. So basically, in a context where there's a lot of spare capacity and there's questions about the demand, the market has been fading the geopolitical risk and sort of trending lower, as you indicated. I think that the most near-term risk from a supply perspective is actually if the Biden team starts to more proactively sanction Iranian barrels. But I think that will be more bark than bite. It will actually be very difficult to implement those sanctions at this point, because most of Iran's oil is going to China in non-dollarized trade. So I think that unless there is an actual hit to oil supplies, even if this conflict escalates, unless it's going to involve Iran directly, even if it escalates just in the form of Iran's proxies, whether Hezbollah, Hamas, the Houthis, and as we've already started to see that it's escalated from those proxies, there's not going to be much reaction in oil unless Iran is involved directly, or unless we see direct targeting of oil assets.
We were watching, especially as many world leaders and business leaders descended upon Davos or not Davos, excuse me, Freudian slip there, Davos in the desert, where there is much conversation taking place there. And it's only right that they also note in some of those talks, too, that Saudi Arabia had announced cuts to its own production. Where do you believe that there's going to be, at least from that instance or that summit, more of the conversation around where some of the cuts that had been initiated by Saudi Arabia, by Russia, will perhaps be taken off the table, or do we expect those to just remain on long term in this near term as one of their own kind of pricing mechanisms or pressures that they can put on the larger global economy?
Yeah, so I think that Saudi Arabia is going to be very reluctant to add those barrels back unless prices really start overheating to the point where we see demand destruction. And I think that Saudi would need to see sustained prices over 100, maybe even $110 a barrel for some period of time before they start to do that. I think that Saudi Arabia is very worried about the impact of higher interest rates in most of the developed world and a slowdown in China. And so they are trying to front run a downfall in oil prices by keeping these production cuts in place very early. Like, they started them, earlier this year, and sort of front run what they see as this slowdown. So I think that they'll be very unlikely to do that. At the same time, Russia actually has not been compliant with their production cuts that they just announced. They were offline a little bit for maintenance. Now seaborne exports of Russian crude are actually starting to ramp up. So I think in an environment where there actually is a lot of supply in the market and demand is questionable, unless there's a really big conflagration, a spread in the war, Saudi is really going to be sort of reticent to add more barrels.
Tamar, really good to see you this morning. Thanks so much for joining us, adding a lot more context on this for our viewers here. I just noticed that the globe behind you is also spinning and rotating too. Okay, we got rid of a shot.
It's solar powered.
Tamar, it's solar powered? What?
Yeah, but I'm sitting here.
Tamar full screen again? They need to see the globe. They need to see the solar-powered globe that is behind her. Okay, amazing here. Tamar Essner, Vectis Energy Partners Principal. Great to see you, Tamar. Talk to you soon.